Hi. Good afternoon, everyone. Thank you, Karlo, for your introduction. Wow! Daming information na na-share sa atin ni Melvin. Very interesting, very intriguing, as I suppose. So, marami tayong natutunan. So, okay. Our role now is to give you, or my role is to show you what are the opportunities naman for 2026, given the backdrop that Melvin showed earlier. In COL, we're not just a broker for the local equity markets. As you know, now we have been offering funds through the platform, not just local funds, but global funds, global investment. So this afternoon, we are actually focusing on global portfolio or diversifying your investment, not just in local, but also in global investments. It is now available, especially for those mga new mga bago, or those who are not yet clients of COL. You can access global investment through your COL platform in pesos. You don't have to buy dollars anymore. Kasi we were able to give you access to these global investments. Okay, let's get to it na. Let me share my slide. So that nakikita niyo na ba yan? Can you give me a thumbs up if you're seeing the slides? Okay, good. Okay, my topic is globalizing your portfolio. Let's just get a review of what happened so far during the year. Yeah. So nakita niyo, in-explain na kanina, China equities really did well. As of November 19 tong ginawa ko, 28%. These are the indices of the world, meaning they represent what's happening in the world. I shortened it lang so that you can have an idea of the ones that are more interesting. So China did about 28.68%, and for the past 3 years, 43%. But before that, negative siya. And the MSCI All World Index is the equity index of the world. It's up to 16% year to date. That is the global equity. Kung may bibilin kayong global equities for the first time, it should be the ones that in the MSCI All World Index. Meron tayong fund dyan, which I will talk about later. Yung US equity did 12.5%. 66% for the past 3 years. So, lakas niyan. India equities also, so far, 9.6, 41% past 3 years, doing well. Global REITs also did well, 7.6. In global bonds, nakita nyo naman, it also earns 7.34% year to date and 12.84 past 3 years. Meaning, it has been accumulating that kind of return. Philippine bonds also did well. So, it is not true that you don't earn so much in bonds. You can earn also a very decent and even less risky investment by investing in bonds. So you can really diversify your portfolio, not just in equities, but also in bonds. Now, the last but not the least, of course, unfortunately, the Philippine equities. Yan ang medyo hindi natin masyado naasahan ng nangyari. But, these things happen, and the Philippine equities is the ones that's really lagging. But I think for the past week, medyo nag-recover na, no? Umagalaw na ng konti. Now, so, before I proceed giving you what we recommend for 2026, there are also risks that we're facing that I want to remind everybody, especially for the first-timers. You have to be aware that in any investment, there are risks. And when those risks happen, don't be too afraid. What you can do is you manage it. Manage the risk. We're in the business of managing the risk, not avoiding it, but managing it. And how do you manage it? By managing the investments that you make. You cannot control what's going to happen outside. You cannot control what's happening to the world. You cannot control what's happening in the Philippines. What you can control is what you will invest. That is what you need to manage. So, what are the risks that I'm looking at? AI bubble. So, sinabi kanina, there might not be a bubble, but a lot of people are expecting a bubble. I've learned that if everybody's expecting a bubble, it might not happen anytime soon, but it could also happen anytime soon. So we have to be aware that it could happen. AI has driven all markets, has driven the US market, the global market, the Chinese market, and it can also drive it down. We just have to be aware of that. Okay. Next, inflation can reemerge because governments are spending money. There be fiscal deficit. Tariffs is affecting prices, and also the high interest rates currently in the world is also affecting. It could also affect inflation. Even if it's going down, it can re-emerge again by the second half of next year. And third, US recession can happen also. There are reports already that the labor market in the US is faltering. There is a increasing unemployment, and there are things happening. It remains to be resilient, however, but there is still that risk. And last but not the least, you know naman what's happening in the Philippine economy. People are holding back their investments. People are holding back. The government is holding back the projects. Things are happening, that could affect corporate earnings. We already saw third quarter GDP was only about 4%. Even people were expecting more than 5%. Because the government held back the projects. And I think what's happening and what's going to happen moving forward, we are really at a juncture. Government, if they handle this poorly, we can just continue to muddle through. People will not be too happy if the government is not able to handle this well. This corruption thing, but if they handle it well, it could probably be a good sign of a change, of a pivot in the way we do things. One thing I learned is that the Philippines now has money. In other words, there is a budget. Unlike before, maybe a decade ago, wala tayong budget. Ngayon, may budget na. Except that we just learned that it's going to the pockets of some people. So now, if that is checked, I hope things are going to do well. It will go to the projects. It will go to the development of the country, and so forth and so on. Cross our fingers. But these are the things that we are going to face for 2026. Okay, having said that, what are we going to do? In COL, we have a lot of investments available for you. We provided access and guidance. That is what we do here in COL. Access through these global funds, fixed income, multi-asset, global REITs, income paying, global equities. We already made it available for you at the click of your finger and in pesos. And we are giving you guidance like today. We continue to provide guidance, research, strategy, etc. So you are better guided in your investments. So what are our opportunities for next year and our top fund recommendations? So there are themes that I'm looking at. So to simplify it, maraming themes na mangyayari, but let me just simplify it through the following themes. Number one, income-paying investments have really gone up simply because earnings have grown. Companies continue to earn, and interest rates are high. And markets are a bit volatile now. So, especially for the starters, especially for the first-timers, I would consider this theme as your first pick. Income-paying investments. The one that gives you income on a regular basis, the one that gives you dividends. And my suggestion, as soon as you get these dividends, this income, you reinvest it right away so that you will earn from the power of compounding. Next theme is really the broadening out of the global growth. It's not just going to happen in the US anymore. The AI story, kumakalat na. It has gone through different other countries as well. So let's not concentrate too much in the US. US is still the largest, but let's not concentrate too much. let's diversify across. And last but not the least, Philippines, you will have to approach it in a very selective manner. There's still economic growth in the Philippines, although slow, but we expect opportunities to still come up, most especially the ones that are giving you good dividends and selective. Okay, number one, for the income-paying investments, what we have to look at the yield and stability, giving you 5 to 6% return or dividend payments with low volatility, meaning mas less volatile siya than the stock market. That's to be consistent. We have funds. We have, actually, I'm going to give you two funds that we recommend that's giving you dividends for a year, 12 times in a year. Every month, it gives dividends. And there is an appreciation potential when interest rates are cut or as governments cut interest rates. As we explained earlier, there's an expectation of another 50 to even to 75 basis point cuts or 2 to 3 cuts by the Fed and even other central banks, including the central bank, RBSP, that will give you a potential for capital appreciation. Historical performance show, on top of the dividends, so the interest income that you earn, there is a capital appreciation of 4 to 5%, especially for investment-grade bonds. Okay, what is the fund pick that I recommend, that I like? US Bond Income-Paying Fund. We call it the BPI Global Bond Income Fund. So, this is just a new fund. It was just launched in May this year, and it's already doing 5.72% year to date. It is a fund, it's a peso fund, but feeds in the global PIMCO fund. The PIMCO fund is the star of all fixed income fund managers in the world, and they're doing very well. And this fund is giving a dividend payout of somewhere around 5 to 6%. Now, the latest is 5.92% net. And the reason why it's doing that, it's invested globally. In the United States, about 80%, UK 16%. The US kasi it's give you high yield. It's invested in government-related, securitized, investment-grade credit, high yield credit, emerging markets. I mean, it is diversified across different asset classes and different investments. And we have studied the fund, and this fund, even if it just launched in May this year for the BPI, the fund, where it is invested, has been managed for more than 10 years, and it's been doing very well. So this is the first pick. It gives you a dividend, good dividend yield, and potential for capital appreciation when rates are cut. Next, the Manulife Global Multi-Asset Diversified Income Fund. Ang haba, we call it GMADI. It's a fund that provides income as well. It's now a balanced fund paying you a dividend. So far, the payment of dividends is about 5.6% net. It has been paying, and nakita nyo history niya of payment every month nagbibigay with an annualized yield of about 5 to 6%. Plus, there's also a cumulative performance of about 14.78% so far. But of course, historical performance is not a guarantee of future, but we believe that this fund will continue to give dividends for the coming periods. And the reason for that is that it's invested in high-yield bonds, developed market equities that give high dividends, equity-related securities, and investment-grade bonds. So, iba-iba rin ang investment yun. It also invests in stocks because it's a balanced fund. It also invests in Microsoft, Nvidia, Broadcom, Alphabet, Amazon, and it also invests in other fixed income instruments that provide you a high dividend yield. Next theme is really the broadening out of the global growth. I mentioned that it's not just in the US. What we recommend, or what I like, is that there is a expected earnings growth for the global corporates of about 13% next year. And again, expected to be powered by AI and tech, about 17%. And the broadening rally in the US, broadening rally outside of the US is now very apparent. The -10 is the year-to-date return of the dollar. Explained earlier by Melvin that the dollar has weakened. And if interest rates continue to go down, the US dollar is expected again to weaken. And that is why we are looking at investing not just in the US, but also outside of the US for you to diversify. And there are now about 51 markets that is outperforming the US. And number one of them is China. We are looking at China, and it is the cheaper way for you to get into AI. Hang Seng is only 12.2 times PE, and the China is only 15.7 times PE, the CSI 300, versus the PE of the S&P 500 in the US of 24.7 times. And ito ang pinakamalaking reason, to my mind, why China will continue to sustain. I mean, the Chinese market will continue to sustain for a long period of time. They're the highest savers in the world. Right now, they have $22 trillion in the bank. The Chinese citizens has saved about $22 trillion. In comparison, explained earlier, the US has about $7 trillion in money market funds. China has 22 trillion. And it continues to save. And the reason for that is that they stop investing in property, they stop investing in fixed income because the interest rates are very low, 1.7% na lang ang 10-year bond nila. The property market did very bad, so they're not investing in property, but they continue to earn and they continue to save. And they have saved an accumulated $22 trillion. And part of that is invested in the China stock market. Slowly. These are just in banks, deposit in banks. These are, well, there are about 600 billion estimated already moving to the Chinese equity market by the Chinese citizens pa lang. So yan pa lang, nakikita natin that there is a very large opportunity for these Chinese to start moving in the equity market as well. And our fund pick is number one, is the global equity. And the best representative for the global equity is the Sunlife World Equity Index Fund because it's invested in the world. It is the index is the MSCI All Country World Index. It just follows that index where it is 65% in the US and about 35% in the rest of the world. And it is invested across different stocks around the world. And now it's the top 10 is a lot in the US simply because, but meron ka pang ano dyan, meron ka dyan Taiwan. This is just the top 10. But the idea is not to focus too much in the US, but invest in the world. The next is the Manulife Dragon Growth Equity Fund, which is invested in China and Hong Kong's emerging tech leaders. So this is the fund that we like for you to be able to ride the opportunity in the Chinese market. So far, it has already done 42%. And we still expect it to grow, to perform well over the long term, maybe experience some volatility in 2026, but we expect it still to generate good returns over the long term. It is invested in the tech companies, Tencent, Alibaba, Xiaomi, and other companies in China Construction Banks, the largest, AIA, Hong Kong Exchange, Ping An, the largest insurance. So it is also invested in different companies and concentrated in China. Your way to ride the growth in China. Okay, last but not the least, of the themes that we have, the third theme is to be the Philippines. Let us not forget the Philippines. We are saying to globalize your portfolio. Don't just invest in the Philippines, invest around the world, but do not forget the Philippines. But the way we will approach the Philippines is really to be very selective. You have to be actively managing your portfolio to capture the value in a deeply discounted market. So we have seen the bottom of about 5,584 recently, and it's like a pandemic pricing. It is the low in during the pandemic. And since then, since the 2020, earnings have grown already by 70%. From 2020 to today, the earnings per share of companies, they have grown by 70%. And we're still about what? Around 6,000, di ba? And it gives dividend yield about 3 to 6%. Because earnings have grown, companies are now able to give more in cash dividends. And what's more, 19 already of the large companies in the country are buying back their stock. That gives you good reason, good confidence that the owners themselves believe that there's so much value in the companies in the stock market. And for 2026, where people are looking, or the Bloomberg consensus is looking at 7% earnings growth. Still decent, and for the whole market. And still at a very low P of 8.7 times. So the way we approach it is really active management, or very selective. And there are two funds that we like. Number one is the Philequity Dividend Yield Fund. Simply because this fund focuses on companies that paying high dividends. So it has done well. Year to date, 4.8. Past 3 years, about 33%. It invests in stocks that pay high dividends, and they reinvest the dividends. So you have compounding on that end. And it has outperformed the market for several years already. And the next fund is our very own CEO Strategic Growth Fund for active. The reason why we like it is because this is actively managed. It is not, it is still negative now, simply because the market is down, but it has pared down the negative. The market was down about 8%, and now it's only just flat, about -1. And it is very flexible in terms of its asset allocation, and it has outperformed the market. If you participated in this fund in its inception, you're still up by 4%. You're still positive. And with that, it invests with a lower volatility in terms of its performance. Okay, so there you have it. In summary, let's look at the different things that we're looking at. Investment opportunities. Number one, income-paying investments. You have the BPI Global Bond Income Fund. We like it because it is a bond fund that gives you dividends of about close to 6%. And it will benefit from the declining interest rates. Second is the Manulife Global Multi-Asset Diversified Income Feeder Fund. It gives you a dividend yield of about 5 to 6%. And it is a balanced portfolio. It invests in global stocks and bonds. And the next one is the global equities, which is the Sunlife World Equity Index Fund. It's your way to access the world, the highest or the biggest companies in the world. That is how you access them, whether these are the Nvidias, the Tesla, the Amazon, the Microsoft. Ito na lang bilhin yung fund instead of buying your own stock. And the other one is the way to ride China is the Manulife Dragon Growth Equity Fund. You can tap into emerging cheaper tech stocks that rival the global peers. And the last but not the least, to be selective in your Philippine investments, get high dividend, Philippine High Dividend Yield Fund, and CEO Strategic Growth Fund for your active management. Okay, so with that, let me just end by giving you some investing reminders. because the markets are volatile, it does not go up on a straight line. Please be reminded that volatility in the markets is normal. So when there's volatility in market, just focus on your long-term growth, long-term strategy, not the short-term noise. Invest for the long term, which brings me to the second reminder. Invest for the long term, 10 to 20 years, diba? Think in years, not in months. Don't time the market. Just strategize your portfolio, manage your risk by allocating in different assets and invest for the long term. Third is you manage your risk, as I said. How you manage your risk is to match your goals. If it's long-term, stocks, long-term bonds. So short-term, you have money market. You manage your strategy, manage your portfolio according to your risk tolerance. And then, most important also is you invest regularly. Invest a certain part of your income, 20% at least, put it in these different funds on a regular basis. Don't worry about the volatility. Invest for the long term. Invest for your future. Make it consistent. Reduce timing and build discipline. And last but not the least, diversify across asset. Don't put your eggs in one basket. Spread your risk in sectors, asset class, and geographies. The reason why we're having this conversation is we want to give you access to the world, and we want to provide you guidance on how to do it. So, five reminders for all of you. Make sure that you remember them, take a picture, and then start investing. So, that ends my report. I think we will open the floor to questions. Thank you very much, everyone.